Ladies and gentlemen, welcome back to another video. I'm your host, TheDividendAristocrat, and today we're going to be talking about a company I'm sure you all are very familiar with, Nike. As always, before we get started, let me give you a quick update of my portfolio performance. In total, I'm up 26%, which is down a decent amount from a couple weeks ago. My total portfolio value is $36,500, and with the continuous pressure caused by inflation, I would not be surprised if my value continues to trend down over the coming weeks. As a reminder, this is not financial advice, and I'm just merely sharing my opinions on this channel. Moving into Seeking Alpha, we can see that Nike has had a rough start to this year, down over 15% year to date. If we do compare to the broader market, or in this case the S&P 500, we can see that the S&P 500 is up over 7% year to date, so that's greatly outperforming Nike. And in the past year, a similar pattern can be seen. Nike's down over 26% in the past year, and we can see that it bottomed out in around October of 2023, only to increase nicely towards December of 2023, but since then it has a pretty sharp decline. Right now it is sitting extremely close to its 52-week low, and we'll see where that goes from here. Now, in comparison, the S&P 500 has performed almost inversely to Nike, up over 25%. It's been a pretty straight shot up, aside from a little bit of a dip towards the end of October. Nike is an incredibly strong company, and it holds over 38% of the total footwear market share. Whether you are from the US or not, almost anyone you'll ask around the world will be familiar with Nike and their products. Odds are, if you are watching this video, you probably have worn Nike apparel at some point in your life, whether you know it or not. And if you guys did not know, Nike does own Converse brand as well. Now, in terms of Nike's 5-year performance, it's only up 6.68%, which is not great, but on a brighter note, its 10-year performance looks much better, sitting at 147% price appreciation. Now, as always, this does not take into account dividend yield, so if you factor in the dividend yield and you reinvest those dividends over that course of that time, you'd actually be seeing some pretty good returns on the company. Now, just to be transparent with you all, I do not hold this company in my portfolio at the moment, but it is a company I'm currently considering adding. If not for the high number of holdings I already have in my portfolio, I would be very inclined to start a position right here. I think depending on what your expectations are for this company, you might actually find this to be a good opportunity to start a position in it because it could be a discounted price compared to what you would have bought it for in the past couple years. If the company continues to execute, that is growing their sales, increasing their free cash flow per share, increasing their earnings per share, you could definitely see a good increase in stock price in the coming years. Now, I do want to point out that when holding individual companies, it is important to look at their long-term performance and how you expect them to execute over a long period of time. Even though Nike has underperformed the market recently, there is a lot of reason to believe that in the future it could start outperforming the market once again. An individual company is likely to have bigger swings down and bigger swings up than the entire stock market. So as you do lower diversification in your portfolio, you are prone to more risk, but you could also see a higher upside than you would by owning the entire stock market index. My point here is just that with these kinds of companies and these kinds of opportunities, don't expect turnaround plays to be very quick. Sometimes they may take a couple years in order to execute. If we do take a look at the worst performing stocks year to date within the S&P 500, we can see that Nike ranks in at number 473, down over 15% year to date, which is not great at all. Comparing that to the best performers in the market, we can see that Super Microcomputers is up over 216%, Nvidia is up over 78%, and Constellation Energy and Meta Platforms are up over 64 and 44% respectively. Now, the year has only just begun, so you will see by the end of the year how these companies end up performing, and I won't be surprised if these will switch around a lot by then. Although Nike has had a bad year in general, their stock price has dipped down very aggressively very recently when they announced their Q3 earnings results. Earnings themselves weren't that bad, with Nike beating out expectations on both earnings per share, gross margins, and revenue. However, what did concern investors is their forward-looking guidance for the company. Most investors found it very underwhelming, and in turn the stock price dipped down pretty aggressively, and that's because the price of a stock is based on its future earnings potential. Now, in order to get a better understanding of this company's financial performance, we can look at some of their financial metrics, starting with revenue. Nike brings in insane amounts of revenue annually, and their footwear accounts for nearly 60% of its global revenue per year. Now, their total operating expenses have also been increasing over time, which is not the best thing to see, but most companies are going to have increasing operating expenses. It's to be expected. There's many different factors that play into this, such as inflation and cost of goods, and so it's not a big deal as long as their revenue is increasing at a faster rate than their expenses. Now, we'll take a look at this in more detail in a second, but their dividend per share and their payout ratio are very important metrics to look at for a dividend growth company. Their dividend per share has been increasing very aggressively over time, mostly double-digit growth for a lot of these years, and their payout ratio has overall been decreasing over time. We can see with their pay ratio that in 2023, it was sitting above their pay ratio in 2022, but that's not a concerning thing at all since they're still under 40%, which in my opinion is very healthy. And if we look here, we can see that in 2021 was their highest payout ratio at 57%, so they've since reduced that very aggressively. If we take a look at Nike's balance sheet, we can see that their total common shares outstanding have been decreasing over time, which is something I look for in almost every company I invest in, with of course a few exceptions to that rule. And if we do take a look right here, we can see that Nike is no exception to that rule, and they have been decreasing those shares aggressively over time with a few exceptions. And if we do notice right here, we can see that in 2023, the total shares outstanding are lower than in 2022, which is a great sign, and it means that they've been buying back shares. While we're here, another thing we can take a look at is their total debt, which is relatively high, but we can easily notice that it has been going down over time. And if we take a look at their net debt, we can see it's easily covered by their liquid assets, which is great. Now, their stock-based compensation is a little bit steep and the graph is increasing very quickly over time. It's not the worst thing ever for this company, but it's something that I really do hope that they get under control in the future. I would love for it to stabilize and kind of balance out and stop increasing as quickly. Too much stock-based compensation definitely eats into the free cash flow of the company and also dilutes the shareholder depending on where they're pulling the stock-based comp from, of course. Nike's capital expenditures definitely look safe to me. In 2019 and 2020, they spent more on capex than it did in 2023, which is great. So it's definitely stayed flat, if not decreased over time, which is something I'm not concerned about at all. And that money is going back into the company, whether it's to build more factories or, of course, to invest into other business sectors. Now, the repurchase of common stock kind of goes hand in hand with their total shares outstanding. So we can see that in 2023, they have spent the largest amount on share buybacks that they have before. And 2022 was aggressive as well, with 2021 being the smallest year, which is kind of to be expected, probably still residual effects from COVID-19 and the higher stock price that they experienced in 2021. As the price of Nike continues to trend down and stay at these lower levels, I do hope that Nike continues to purchase more shares back of the company. I think this will be a great opportunity for them to increase their own ownership and increase the ownership of the shareholders of this company. Not only that, but at these lower prices, this will definitely help push back the value of these shares and increase their earnings per share of the stock. I would much prefer that companies spend more on stock repurchases during periods of time where the stock price is lower, because I think they'll definitely contribute to their gains in the future. Now, their free cash flow per share does show a different picture from the rest of these metrics. We can see that in May 2020, as we would expect, this was the lowest amount of free cash flow per share they've had in quite a few years, but in May 2021, it increased pretty aggressively. Since then, both 2022 and 2023 have had lower free cash flow per share, but I think in 2024, if they execute correctly, they will actually break that record set in 2021. The reason that free cash flow is an important metric to look at is that a lot of times dividends are paid directly from the free cash flow of a company. Now, speaking of dividends, taking a look at their dividend scorecard, we can see their current yield sits at right around 1.6%, which is right where I like it. I like it to be between 1% and 2% ideally. If it's too high, I think kind of eats into my gains a little bit too much, and I have to pay tax on that, of course. And if it's too low, I don't think it's substantial enough to make a snowball effect unless the dividend growth is very aggressive. Now, here we kind of have a double whammy because it not only has a nice dividend yield that's not too high and not too low, but it also has very aggressive dividend growth that will make your yield on cost be worth a lot more over time. At an 11% 5-year growth rate for their dividend, it's evident that they have had double-digit increases for that dividend, which is something that I really like to see in a company, and their pay ratio is under 40%, which makes it still a very healthy range to be in. Now, in terms of how many years they have been increasing this dividend consistently, we can see it's sitting at 11 years, which is great. It's no dividend aristocrat just yet, but it will be there soon. Now, if we take a look at their 5-year graph for their dividend yield, we can see that it's sitting at a nice and high 1.54%, which is significantly higher than its 5-year average, and it actually bottomed out right around 0.6% back in 2021 when it's hitting those record highs. Now, based on dividend yield theory, this might show undervaluation of Nike stocks, so it could be a good time to purchase if you are looking to base it off of that. I think entering a position at initial yield of 1.54% for a company like Nike is not a bad opportunity at all, and it could actually prove to be a very good investment in the long run. In terms of dividend history, which we were discussing a little bit earlier, we can see that in the past 10 years, the dividend has increased very aggressively over time. And in 2014, it was sitting at 12 cents per share. Fast forward to 2024, it is sitting at 37 cents per share per quarter, of course. That is over a 3x increase in the dividend over a 10-year time frame, which is absolutely amazing. And it's something you want to see in every dividend growth stock that you invest in. Now, their price to earnings ratio is sitting a little bit rich right now at 25, but if you look at their 5-year average, it's actually significantly lower. It's a 25% discount to their 5-year average PE ratio of 34. Now, of course, investors can't expect their company to hold such a premium at all times. 34 is a little bit high even for a company as good as Nike, but 25 does seem low compared to their average. Assuming that Nike begins to trade at a richer valuation once again in the coming years, maybe even a valuation of 30, there could definitely be good price appreciation to be had just from that alone. Now, part of the concern of this company is the revenue growth, that is their ability to sell more products and continue increasing the amount of money they're bringing in every year as a company. If we look at their year-over-year growth, it's sitting at under 2%, which is way under their 5-year average of almost 7%. And in terms of their forward-looking revenue growth, it is expected to be at 4.2%, which is also significantly less, almost half of what it is in their 5-year average growth. Now, even though the stock price usually prices in stuff like lower revenue growth or lower expected earnings, this doesn't mean there's no risk at all associated with Nike at this time. Same way there's upside with this company, there's definitely downside potential as well. Now, I do think that this graph does a better job representing what I was talking about for the price to earnings ratio. So you can see the last time this company was this cheap as it is trading to right now was in 2020. And in 2021, it's trading significantly richer than this at almost an 80 price to earnings ratio, which is very steep. I think that if this is a company that you've definitely been looking to invest into for a long time, now could definitely be a good discounted price to start an entry point in. Now, of course, as I always do remind everybody, just because the company is at its 52-week low doesn't mean that it's undervalued. And the same thing can be said for its 52-week high. Just because one is sitting at its 52-week high does not mean it's overvalued, as we've seen in companies like Super Microcomputers or Nvidia. There could be a ton of different reasons why a stock price might continue to trend down, or vice versa, why a stock might continue to climb, and it's not always based on earnings directly. For a lot of people, the best approach to buying into a new company is to just dollar cost average. That way, if one week the price is higher than the next week, you can easily average out your price over a longer period of time. This helps a lot of people with both FOMO and worrying about if they're buying at a too expensive entry point. As always, this brings to the end of today's video. I really hope you guys enjoyed this spotlight video on Nike. And if you found it useful, definitely leave a like. And if you haven't subscribed to the channel yet, please do so. It helps me out a ton. Also, let me know down below whether you've already bought Nike or if you have plans to in the future. If you do want to see me go through Bill Gates' portfolio, check out this video right here. And if you want to keep up with my monthly dividend income, check out what I got paid in March right here. Other than that, I hope you all have a great rest of your day, and I will see you in the next one.